In this lecture we are going to study a market manipulation example that involves the use of a wash line to trigger a trade opportunity. This example also includes the mixture of an economic news announcement with a pure market manipulation. As it was pointed out in previous lectures, these two elements can certainly go together simply because news announcement increase the volatility, and that can be very useful for market makers. The starting point of our analysis of a market manipulation in alignment with news announcements is that market logic remains intact despite the sudden shifts in volatility. In other words, the basic mechanics of price are still the same regardless of what news announcements come out. Another way of looking at this is that these announcements only add fuel to the fire of price action, but they don't change how the fire burns. One thing that confuses many traders is the fact that these movements happen too quickly, and this is something that creates the illusion that news announcements break the natural order of price, but according to the school of thought that we adhere to, this is not the case at all. The reason this is not the case is that no matter how dramatic an announcement is, it still needs to respect the supply and demand mechanism of the markets. This underlying mechanism is the absolute basis for the creation of a market in the first place, and it cannot be broken in any way. If we consider that, we will be able to see that news announcements and market manipulations still must function within a predictable framework. That's good news for all traders who understand the psychology involved in manipulations, because we can have a firmer ground to predict how price is going to behave around these events. It's important to clear these things up a little bit because some traders think that news announcements are some sort of market miracle or a temporary suspension of normal market logic. If that was the case, we would have absolutely no ground to analyze the charts around these areas. The most primordial assumption here is that market logic cannot be simply suspended randomly. It must be a hard and unbreakable concept. In this chart we have a very good example of this. From number 1 to 3 we have the classic major flow formation of a downtrend. In other words, lower lows and lower highs. From numbers 4 to number 7 we have what appears to be the minor flow of this market, which is also going down momentarily. The key to placing these market vectors correctly within their hierarchy is to compare their size and volatility. Take a look at the difference between vectors from 1 to 3 and the vectors from 4 to 7. We can safely say that vector from 1 to 3 is twice as big, so in relative terms, we have well-established major and minor flows. The problem is that when you look at the minor flow between 4 and 7 alone, you can have the impression that it is a major flow. It's a matter of frame of reference in this case. This is probably the most confusing thing about this chart. Right after number 7 we have a massive upward candle that wipes out highs number 6, number 4, and number 2. In other words, a candle that takes out minor and major highs of the market. In the light of the tridimensional axis of market manipulation we have been talking about in the theoretical and practical lectures of this course so far, this massive candle is clearly the von Restorff effect in action. When this candle appears on the screen, you cannot take your eyes out of it simply because it stands out too much. The fact that it moves quickly does not help either. However, if we take a cold look at what happened here, we will see that many retail breakout traders got their long positions triggered, especially in major high number 2. When price was up there near high number 8, these retail traders were thinking they got the market figured out. The second part of the manipulation is when market makers start to hammer the high of candle 8 to make it close below the high number 2. This is a poking movement that creates desperation in those long retail breakout traders. At the closing of candle 8, many retail traders are already stopped out and looking for revenge. In other words, the reverse psychology worked like a charm by triggering traders to the upside only to create the revenge for the downside. This is also the beginning of the bandwagon effect because many retail traders are looking to recuperate their losses, and therefore, they are looking to go short now. The important detail here is that large traders already got in their short positions when they started pounding the high number 8 down. They did this by taking advantage of the cluster of orders from retail traders at high number 2. When high 8 pokes high number 2, a deep liquidity pool for the downside is opened, and large traders immediately get in. This is why they need retail traders to enter massive positions in the market. From this paradigm we can characterize high number 2 as the level wherein retail traders got washed out of their positions. The horizontal line you see labeled wash line is precisely that. The precise level wherein retail traders got hurt. This same level can be used as a sneaky way of entering the market after the most violent parts of the manipulative maneuvers are complete. The short position you see opened in the chart was opened with a sell limit order in the wash line. After candle 8 closed, price opened below the line and a sell limit order was placed at the wash line with a stop above high number 8. Observe that the candle marked by the green arrow tests the wash line and price starts to go down. The target is naturally at least 3 times as big as the stop loss for us to have an expectancy value higher than 1. Let's see how the market reacts. As you can see here, a nice downtrend started after the manipulation in number 8, and our short position proven to be correct.